All right, so hello and welcome to another Monster Candle Trader video. Today I'll be going over my full model setup and trading strategy. It's the one that I've settled on for a while now, and I believe it's the best strategy that I have ever used in regards to consistency and how straightforward it is. Now, as you can see here, we are on the disclosure page. And of course, a bit of disclosure about myself just to have complete transparency. I am not a profitable trader. I've been trading for like 3, 4 years now, and I have only in the beginning I got a bit of beginner's luck, and since then I've been pretty much been striking out since. The reason why I'm still creating this video is for a friend, of course, and I believe that this strategy in of itself does work. My main struggle in regards to the mental aspect, where I'm always put myself in situations where I believe I need to become profitable quickly, and as such, I tend to go into spirals where I break the rules of how much trades I take a day and just how much loss I'm willing to take in a single day, right? So just wanted to get that out of the way. All right, so let's get started. So we're going to be looking at the New York session. My model is all around master in the New York session, which is in the 9:30 opening. All right, so chart markup settings and time for your chart. Now it's important to spend time in the market, which is one of my biggest weakness. The longer you spend in the market with a decent strategy, you'd eventually become successful through compounding, right? So you want to spend time in the market, but just as important, you want to learn how to time the market. The market runs based on time. If you're just jumping in whenever looking for your setup, most of the times you're going to be finding yourself in situations where your setup is not a high probability setup and you'll suffer losses. So let's take a look at the times. So for this model, you'll start at 9:30 a.m. New York time. That's 9:30 a.m. New York time. Once you start looking for it there, it really depends on the new setup, which is going to be in the next slide that I'm going to be taking a look at. So for example, you go in at 9:30, and once I explain the model, you're looking for a setup. You find a setup, you take a trade, and it works out all well. So for example, you go in at 9:30 and there's nothing. You're unable to see the setup that you're looking for. You'd wait until 10 a.m. to see if there's another opportunity. If there's isn't another opportunity at 10 a.m., you wait until 10:30. If there still isn't an opportunity, that would be it for the day, right? Of course, I'll be going into the nuances, what the model is later on. So let's go ahead and take a look at the next slide, which is following the news events and how they affect the charts. Now, it is really important to stay in touch in regards to the news events. I mark the orange and red folder news, but the most important are, of course, the red folder news. Whenever you have a red folder news, it will affect the market, whether it's on the specific time of the news where there's like massive jumps, right, where the spreads open up and can cause it to take massive losses, or it is prior to the news where the market is just consolidating or it's not moving smoothly, or it could be even after the news where everything is going fine and then after the news the market just start going crazy, wicking up, wicking down, consolidating for a time, doing small runs into reversals. So you want to make sure you keep a track of the time. So pretty much the ruling for the time is that, for example, you start trading at 9:30. If there's a news at 8:30 a.m., what I would advise you to do is to caution and just wait until 9:50 to start looking for your setup. There are days where there's a news at 8:30, and because the market offers a such a I call those days free days, where it is so obvious that you pretty much can't ignore it. What I advise is that instead of taking like a typical entry, what you want to do is to take the most optimal entry, even if it means going in a bit early before the typical setup starts, so that way you're in the prime position of the trade. So whatever retracement takes place later on, you'd be still safe. Now, So I gave you the example for 8:30 a.m. Say that the news is at 9:45 a.m. What you want to do is simply just wait until 10 a.m. for your first trade opportunity, and then you want to wait on 10:30 a.m. for another trade opportunity. So, for example, at 10 a.m. there is no trade opportunity. You'd wait until 10:30, then you look for the trade opportunity, right? And this is the for like beginners. This is the best way to go about it. If there's a news at 8:30 a.m., you don't start trading until 9:50 a.m. If there's a news at 9:45 a.m., you don't start trading until 10:30 a.m., right? And if there's a news at 10 a.m., you don't start trading until 10:30 a.m. That would be the safest way to approach it. All right, let's move on to the next slide. So we're going to be going over to learn the model. So I'll see you on the charts. All right, so here we are for Friday, right? And Friday, the 5th of September 2025. And this is one of those days that is typical for my model. Now, first things first, we're going to be looking at indicators. So here is the first indicator and the settings. So these indicators are typically used to mark out the opening range gap. And this indicator, I'll go on to the second one, will cover the new week's opening gap and the new day's opening gaps. This is very important because it shows where the market will likely to draw to. And you want to have them on your chart. If it's the case that you want to mark it out yourself, you can follow, we can look for an ICT video and they'll explain to you what these gaps are. And it'll also explain how to actually annotate them on the chart. I just use the indicator because it's a lot easier for me and it gets straight to the point. So here are the settings that I'm using for my chart for the opening range gap. And this is from the new week's opening gap and the new day's opening gap. And here are the settings. First, you just pause and take them in. So these yellow areas that are shaded and the purple areas that are shaded are new week's opening gap and new day's opening gap. That is a draw to the market. All right, so first things first, we're looking at 9:30, right? So you now have 9:30 marked out on your chart. And this is where you start looking for trade. So the minute that 9:30 opens, what you're looking for is a draw. All right, so before 9:30, let's do it in order. So first things first, you want to highlight all the areas of liquidity prior to the session starting. And the main way to highlight these areas is to look at relative equal highs and relative equal lows, right? So swing highs and swing lows that are so close that they're pretty much relatively equal. And of course, if you find any that are actually equal, you want to mark them out on your chart because the market is likely to run to them during the New York session. So let's go ahead and see if we can fish out some. So this is not one, this is not one, this is not one. If you realize I switched to the 15 minutes chart, what I like to do is 15, 5, 3, 1, so I don't miss any. So no obvious relative equal low on the 15 minutes chart. Let's go ahead and break it down to the 5 minutes. And let's go ahead and mark out Friday so it doesn't go away too quickly for me. So this is the 5 minutes chart. Let's do the same thing. We're looking for relative equal lows and relative equal highs. So right here, taken. So no relative equal lows spotted. No relative equal highs spotted. Let's go to the 3. There we go, relative equal lows taken, and here, relative equal lows. So no relative equal lows spotted, because it has been taken by this wick here, and no relative equal highs spotted either. Now let's go down to the 1 minute. Let's see if we can find some relative equal lows. I think one is right here. This is a relative equal low here. Got taken out. And let's see if there was any relative equal high. All right, so for this is one of the days where there is no obvious draw on liquidity when it comes to relative equal lows or relative equal highs, which means you want to you move on to the next draws on liquidity, and one is right here, the midpoint of the opening range gap, which is the indicator that I mentioned before that maps it out for you. So this would be a draw on liquidity, and it's going to be the new day's opening gap for another draw on liquidity, including these here. And if you realize there is a cluster down here, so there's a likely chance that the market would want to draw to this area. Now you're going to be looking at let's see if there's any above, and no, there's not. So for this day, because primarily most of the draws on liquidity are to the downside, you're already going in with a bias for a draw on liquidity to the downside. Now we're going to be looking at 9:30 now. Look at the 9:30 opening, and this is the most important part. If you're looking for the market to pull in one particular direction, you want to see it sweep liquidity in the opposite direction, right? And what is liquidity? Swing highs, swing lows, right? Relative equal highs, relative equal lows. If you're unfamiliar with those terms, swing highs, swing lows, there's plenty of YouTube videos you can use to find out what they are. But for example, this here is a swing high, and these are swing lows, right? Now, we're going to be paying specific attention to this swing high here, because these swing lows, because we're looking for the market to draw here, because all of the draws on liquidity that's there, right? On the 9:30 open, what happens? The market wicks higher, taking out liquidity on the buy side, right? So whatever stops were here, the market wicked and take it out. So at this point in time, you know that one, the drawn liquidity is lower, and that the market has did a fake run, which is this wick to the upside, taking out liquidity. So now you're looking to have an entry into the downside. Now, for this entry, this is very, very important because of the conditions that we're looking at. Today was a day where we had news at 10. No, we had news at 8:30 a.m. This right here, this massive wick up and down right here, that was the news. We had news at 8:30, which means that the market, there's a high probability that the market would not make its move until 9:50, right? If you realize at 9:50 it starts taking off, meaning that if you're looking to get an entry on the open where the market wicks higher, you want to look for the highest possible PDRA. So that way, whenever you get an entry, any kind of retracement like you see here would not take you out of the trade. And this is going to be one of the entry mechanisms, right? So this wick higher here, right? If you measure using a Fibonacci, I'll show you the settings. So the Fibonacci tool, if you measure the midpoint here, and here are the settings. You can pause and set it up on your end, right? If you're unfamiliar with the tools, there's plenty of YouTube channels that can help you to get your chart set up, right? This is the midpoint. This could be your entry. This could be one of your entry. right? So your entry would be here, and your stops would be here. This is very important because what? For this entire movement lower, you would have your stops at the highest point in regards to the initial run. So if there's any kind of retracement, you'd be in the clear, right? Next entry, order blocks. So order block is the change in the state of delivery, right? So if the market is running lower and you know that there are bearish candles that are printed, downwards closed candle. If there is an upwards closed candle during that rundown, that would be a change in the state of delivery, and the market would refer back to that candle whenever it's looking to continue its run. So, for example, here, let's follow it from here. The market is running lower, right? You have a change in the state of delivery here, right? Market is running lower. You have a change in the state of delivery here, where it means that this candle here is an upwards candle in this downwards trend. So this could be seen as an order block, right? Just using it as an example, I'll tell you which one to actually use. And it's the same here. The market is generally going down. Each of these candles that are printed up can be counted as an order block. Now, as I mentioned before, when you are looking for these entries, you're looking for the earliest entry in the highest possible position when you're looking for a sell. So you're looking for the safest point. You're looking for the earliest point you can get in at the safest point. So you're not looking for any trades until after 9:30. So once 9:30 prints right here, you're looking for an entry now, right? So this market is running lower, right? Market running lower. Where are where is the best entry that you can find in terms of an order block? Here is one. This is one. And this would be another one. So these are the two highest up close candles in the sequence, right? So these would be the ideal spots for the entry to take place. Now, if you pay attention here, this wouldn't have been hit. If you pay attention to here, this would have been traded into. Let's see if that trade would actually hold. Yes, it would. So this would have been your entry. Right? As said, first target here. Once it reaches here, you take some partial. Second target would have been here. Right? Once it hits, you take some partial. And a third target would have been here. The entirety of this space down here, you can take partial as well, or you could have just simply left it to run. So that is pretty much what a trading setup would look like. You want to highlight the areas that are the drawn liquidity, and with the open, you want to see the market take liquidity in the opposite direction of where the specific target that you're looking for. And then based on the news events and based on the timings, you'd look to take an entry there. Yeah, so that's pretty much it. Let's get back over to the slides. Welcome back over to the presentation, and now we're going to be looking at just a quick summary of what we went over. We have steps how to mark up your chart. I showed you that the different timeline that you need to do. Again, if you're having issues in regards to just the basics of marking up your chart, there's tons of YouTube videos you can take advantage of. to have to provide you with the information on how to market your charts. The next step is to second step was to how to know which days to trade by following the news. The news. I didn't mention that the website that you should go to, but it's Forex Factory. So forexfactory.com, and you want to make sure that the timings that you're seeing there for the news align with the New York session timings. And lastly, understanding the model entries and money management. This is the other part that we're going to be looking at, which is money management. Most of the time that I've been trading with a small balance, right? So anywhere from like 250 to 500. And as such, I was looking to see if I can multiply the account faster. So I was always been trading with like 5%. For a really good risk model, you're just looking for 1 to 2%, right? Most of the times you want to be entering with 1%, and then you can add another percent once you get confirmation in regards to how the trade is flowing. And yeah, that's pretty much it. Great news. I'll be starting a series very soon where I pretty much simulate a funded account. Because as I mentioned before, I really do believe that I have the talent in regards to trading. It's just that I haven't been able to lock in the focus. So that series is going to be about me using a paper account to see if I can actually pass a 100K challenge. So thank you so much for watching. Like and subscribe if you haven't, and God bless.